Is the property industry's life science experiment going as well as landlords, investors and politicians hoped? With so much pinned on big deals, is it time to give the test tube a shake? Put your safety goggles on now. Because this week, we're going to look at the life scientific. I'm David Tame, analysis editor at Place North. In today's Place podcast, we'll ask, is there as much life in life science property as the real estate sector hoped? We'll also be taking a fleeting visit to Leeds' build-to-rent sector and celebrate a super green warehouse in Doncaster. There are just a handful of one-way bets in the property business. Supermarkets, petrol stations, funeral parlours, GP surgeries, those are as close as it gets. Then along came the pandemic and, miracle of miracles, it looked like there was another one. Life science. So long as people wanted pills and jabs, life science would be paying the rent. Build the labs and the R&D hubs and the associated logistics space, and they will come, so the theory went. 4 years on, is the North's property market as shiny and lab-shaped as everyone hoped, or did expectation management get out of control? Maybe it did. For example, last week, Life Science REIT Real Estate Investment Trust, created to ride the investor wave, reported half-year results to the 30th of June. Its portfolio has taken a smallish hit, down 4% to 383 million, and rent grew by $1 million to 15 million, but shares are trading at a 50% discount to net asset value. Brutally, the market doesn't think those labs are worth the valuations, and it thinks the valuations are wrong because the rent isn't anything like what everyone hoped. Now, this ought to have been as easy as shooting fish in a barrel, if oft-quoted and wild supply and demand numbers are correct. So, for instance, in London, yes, miles away, but it's a good example, Knight Frank calculated as this year opened that demand for lab space in the capital was about 800,000 square feet, while availability was just 200,000 square feet. Now, it's easy to get bowled over by numbers like this. It looks like a massive supply-demand imbalance. But experts I've spoken to say that would be a mistake. It's a lot more complicated. The fit between what occupiers want and what's on the market is far from a neat overlap. Meanwhile, investors have piled in. Something like 1.7 billion is said to be available for UK opportunities in the lab sector right now. And the result of that over the last short while is lots more lab space is about to come onto the market. According to CBRE, who keep an eye on these things, something like 2 million square feet of new lab space lands this year, whilst take-up is expected to be not far off the same figure it was in 2022 and 2023, which is 700,000 square feet. And that's a bit awkward, and it's going to push rents down. The dynamics may get worse because the number of big life science players is small and getting smaller. Savills calculates that globally there are 260 companies that are spending at least 100 million euros a year on research and development, and there are 34 companies spending over $1 billion. But it's hard to grow a business like that on the strength of new ideas, and a ton of big patents are about to expire, so buying growth is the easiest option. The result is a string of defensive mergers and acquisitions that will take the number of players down even further. Yes, there are signs of more small and mid-sized contractors, but those kind of businesses aren't quite such solid propositions. Now, it's worth noting how relatively little lab investment lands in the north. Savills produced a lovely little table, Table 4, if you visit their recent analysis, and it shows that a little shy of 5 billion has been invested since 2021, and a shade over 300 million landed outside London, Cambridge and Oxford. That's all peanuts. None of which is to deny the reality of the extended northern life sciences scene, which is a kind of, you wouldn't want to call it a banana perhaps, but maybe more like a suppository-shaped object extending from Chester to Newcastle. Big things are happening, most of the biggest in Manchester, and work is well underway on a series of projects. Look, for instance, at City Labs 4 adds another 125,000 square feet to the Oxford Road Life Science Corridor, thanks to Bruntwood SciTech. At the other end of the corridor, the southern end, the same firm has a new life science accelerator program at Alderley Park, and that's funded through the UK Shared Prosperity Fund. Alderley Park has also scored 50 million of private sector R&D investment, and that includes 19.3 million raised by biotech firm Cellcentric from Pfizer, and that's for development of an inhibitor for multiple myeloma, which, if you know it, is a slow and nasty blood cancer that's almost always diagnosed too late. There are others hitching their wagon to the corridor's undoubted success. This summer, the 60-acre airport city site at Manchester Airport was reborn as Mix Manchester, a 2 million square foot project to deliver advanced manufacturing and science space. It's shovel-ready, says the publicity, as it has been for quite a long time. Partners Columbia Threadneedle Real Estate, Manchester Airports Group, Beijing Construction Engineering Group International and Greater Manchester Pension Fund must be hoping this is the final push. There's certainly logic to the Mix Manchester proposal, but making it pay will be the challenge. It's going to be classy stuff, not just a load of crinkly tin sheds, and premium rents are in the air. Why not? If you want any kind of farmer footprint close to the Oxford Road corridor, this is where you'll probably have to come. Now, how do you get the maths to work? Well, it's not clear, and of course we've been here before. The 1980s and 90s saw a similar pivot towards science, and a rash of science parks sprang into life, ready for a shiny new science-based future. A few survived, Manchester has one of them, one or two thrived, but most no longer exist. Almost all had to abandon the original focus on science occupiers in order to make financial sense. Tenants were not turned away, whatever their line of business. Mix Manchester hopes to hook itself onto the end of the Oxford Road corridor. They want to be the dot on the end of the Eureka! Exclamation mark, which Manchester's science sector looks like on a map. Whether it can or not depends on some very big assumptions being right. And now your regular rundown of what's going up and what is heading the other way in the Place North elevator. Doors closing, going up. The Leeds build-to-rent sector was slow to get going, but it's now gathering pace. This week, Glenbrook topped out the 500-unit scheme at Whitehall Riverside. The two towers are part of the wider £280 million project delivered by Town Centre Securities. Leeds, along with Manchester, is tipped by Savills as the focus for much of the next wave of BTR growth. It comes as confidence picks up speed of its own, albeit from what is still a very small base. The total stock of UK build-to-rent homes is just 115,000. Small, but that is up 24% on this time last year. There's more money sloshing about, and we know those numbers are going to grow. The second quarter of 2024 saw $1.2 billion invested in build-to-rent, and it's worth noting that about 3/4 of that went to single-family housing, not the flats being delivered at Whitehall Riverside. That's an interesting change of direction. It's a sign of the times, and one worth keeping an eye on. South Yorkshire Pension Fund has made a big splash in Doncaster. The fund has lent $54 million to support a 700,000 square foot super green warehouse at Panatoni Park Central A1(M). It's the fund's largest loan to a single project since they set up shop in 2019. The fund has made a few other large and timely investments. They allocated $46 million to develop a 496-bed student accommodation scheme in central Sheffield, and another 33 to support the development of a 367,000 square foot warehouse at Shepcote. The chances are the Doncaster shed could be a big winner. Cushman & Wakefield did some research recently on sustainable logistics across Europe, and they claim that sustainable warehouses command a 19% price premium, rising to 24% outside super prime areas. There are also attractive paybacks on offer, and for investors prepared to get into big sheds, this is beginning to look fairly tempting once again. So that's it for today. We've learned how the spark of life might or might not be the answer to the property market's prayers, enjoyed a trip up the A1 to Doncaster's latest green asset, and dipped a pinky in the flourishing Leeds build-to-rent sector. For more about the built environment in the north, visit placenorth.co.uk. I'm David Tame, and thank you for listening.